Hi, everyone. Welcome to the middle of the year. We've officially made it. And with that, the Carson, well, welcome to First Off Take 5. And Sonu and I are very excited. We'll see if we can keep this 5 minutes. You guys know it's hard for us to keep anything 5 minutes. But we're going to talk about the Carson Investment Research Mid-Year Outlook. Sonu, let's try to keep this in 30 seconds. How surprised are you how strong the first half of this year has been for equities? Then we'll kind of get into how we see the second half of this year going.
I'm surprised. I'm not unhappy.
Yeah, good point.
I mean, who would complain with, 15, 16, 17% returns over the first 6 months of the year? And continuing into July, I should say, into the first week of July, right? So we've had momentum. Like I always like to say, momentum begets momentum. We've seen that.
No, well said. It's the best first half to any election year since 1976. As you know, in these weekly videos, thank you for watching and listening to them. We've been pretty bullish. That's been playing out. So again, our mid-year outlook, we call it eyes on the prize is what we call it. And again, keep this real simple. There's lots of scary stuff that happens. We've been investing a long time. A lot of people have been following us a long time. Keep your eyes on the prize. Longer term investors are going to be rewarded over time, and that's what we really want to focus on. But Sonu, let's start with the economy. You've pushed back against so many bears and so many economists that have told us a recession's coming. You still don't see a recession, do you?
No, I don't.
Good.
Short answer is that, yes, the employment data has been mixed recently. Job growth has slowed, but it's still strong. We're averaging about 177,000 jobs per month. Before the pandemic in 2019, it was 166,000. Now, the unemployment rate has gone up. Last year, this time, it was 3.7%. It's 4.1%. But look, part of it is because a lot more people are coming into the workforce and looking for jobs, which is why one metric you and I follow, that's the employment population ratio.
Yeah.
It's the opposite of the unemployment figure, right? There's no definitional issue as to like who's actively looking for work, who's not, things like that. This is how many people are employed as percentage of the population. And to take out the demographic issue, because a lot of people are retiring month after month, look at prime age workers, 25 to 54. That ratio, employment population ratio for prime age workers, 80.8%, right? That's the highest we've seen in a very long time. I mean, last year it hit 80.9%, but we're close to the peak. At no point between May of 2001 and February 2020 did we see anything, remotely close to that. The highest it got to was 80.4%. That in and of itself tells me the labor market is still strong. It's not red hot. It's still hard. It's not as easy as it was 2 years ago to find a job. So things are easing from that perspective, but I don't think we're close to a recession.
All right, so I'll wrap this up. Bottom line, if the economy is still growing, if people are still getting jobs, if people are still employed, it's tough to have a recession. We see many, many positives still like that. So let's kind of shift gears with no recession coming to the stock market. We came into this year pretty optimistic for equities, and fortunately that's been playing out. We think the S&P 500 total return this year could be between 17 and 20%. Now, honestly, that's not all that far from where we are right now. But again, we still think if there's any place we might tweak with our overall outlook, there could be more gains coming than we see. But we are still overweight equities. We are still quite bullish the economy and the stock market. Just Sonu, just something for people to think about. We had a good first half of the year. Well, listen, when the S&P 500 gains at least 10% the first half of the year, the rest of the year is higher 83% of the time, up a median of almost another 10%. So we just think if we gain another 10% second half of this year, we're not going to be complaining. You're not going to be complaining. I think that's the bottom line is what's driving this. Earnings, corporate profits continue to be strong. Profit margins also have been surprisingly strong. Those two dual tailwinds have been a big reason why stocks have made, at least at the middle of the year, 31 all-time highs. Anything you want to add on stocks, Sonu, before we talk about bonds?
No, the macroeconomic backdrop is great. So nominal GDP, and this gets to the fact that the economy is normalizing, right? Last year, the U.S. economy grew faster than China, 5.5%. China's economy grew about 5%. This year, we've slowed down to about 4%, right? It's not, by the way, 2% or 3%. It's probably close to 4%. That's where we were before the pandemic. That was a pre-pandemic trend. That's a good backdrop for sales growth. right? And that's why companies are doing well.
Exactly. So let's kind of move forward. We're seeing better inflation data, right? We're seeing better inflation data starting to come out. We've been pushing that the inflation should start to improve, and it is. We've got the Fed out there. The Fed has not cut rates as of the time we're recording this, but it's likely they will cut rates in September and again in November. We think these are more surgical cuts, not necessarily the type of cuts that you see in a recession. It's just, hey, they hiked rates a whole bunch. Inflation's last year's problem. They can bring rates down a little bit. And Sonu, what are two areas that could benefit from potentially a little bit lower rates with some Fed cuts out there?
Housing immediately.
Yep.
Right now, mortgage rates are about 7%. If you get to 6%, I mean, yes, it's not the 3% rates that, for example, that I bought my house and mortgage for 3 years ago. And I don't think we are ever getting back there, at least, not unless we have a really bad recession. So not hoping for that, right? But 6% will be some relief. 5.5% will be relief. I remember a decade and a half ago, people are buying, houses with 6% mortgage rates, right?
My first house. I hear you.
Right, there you go. And so I think there'll be some immediate relief there, right? Then we'll see more building activity, things like that. That's what we need, right? So we need more homes. Otherwise, if we don't build homes now, in a sense, the Fed's high rate stance is creating a longer term inflation problem, right? Because people are not, builders are not building anymore. So in 2026, 2027, when millennials, for example, looking for homes, they don't find it, and home prices continue to go up a lot. Mortgage rates are high as well. So I think that's immediate relief. Then business investment, I think you'll see a pickup in business investment if the Fed reduces rates as well.
Well said. So again, we do not see a recession the second half of this year. We think stocks will continue to do well. We think the inflation's last year's problems and a couple of cuts coming in. Let's wrap things up with fixed income and bonds. Bonds obviously had a historically really rough 2022 as interest rates went up. Remember, bond prices and interest rates are inversely related. Last year, bonds gained about 4 to 5% with a really late rally late in the year. As of the middle of this year, Sonu, the Barclays Ag, kind of your average bond fund, is about flat. What would you say to the bond investors out there the second half of this year? Will it be a little bit better, worse? Where should they look for potential gains?
I think especially with the Fed potentially reducing rates, hopefully they don't sit on their hands.
Yeah.
We think that is a risk. But if they don't, yields are going to go down, right? Which means if you're getting 5.5% cash by this time next year, if the Fed starts to reduce rates, continues along that path. I mean, we don't think rates are going to 0%,
right,
even 2%. But next year, this time you're going to be at 4.5%, whereas the aggregate bond index is giving about, the universal bonds is paying about 5%. You lock in that right now. That's the expected return for the next 5, 7, 8 years, right? So this is not a bad time to get back in. And getting back to our own portfolios, look, where could we be wrong if there's a policy mistake? If the Fed does stay too tight for too long, something breaks. There's a recession. We don't think that's a base case, but if there is, we want to be protected. How do we protect against that in our portfolios? We like equities and overweight equities, but we want some bonds in there too.
And if something breaks, if there are problems, just keep listening to these Carson Take Fives. We do them weekly. We will absolutely let everyone know. So with all of that, again, we're so honored to share our Carson Investor Research Midyear Outlook for 2024, Eyes on the Prize. Please definitely check that out and reach out to your financial advisor if you have any questions. And our team would love to help as well. With all that, everybody, it's the middle of the year. Hopefully you've had a summer vacation already. Maybe you got one coming up. Enjoy. Summer's you got a little bit of summer left here, Sonu, but you blink, it's going to be, I saw somebody say like 100 days till football starts or something. But anyway, whatever. No, it's got to be less than 100 days.
Less
Anyway,
than that.
way less. I
Probably
don't know what I saw then.
50 days or something.
I saw something. But anyway, nonetheless, it's been a really good year for investors, good year for the economy. We think there's a little bit left in the tank here. Keep coming back every single week as we do these Carson Take Fives, and we'll tell you all about it. But enjoy our mid-year outlook. We'll see everybody next week. Take care. Thank you.